How's it going, everybody? Welcome back to the channel. My name is Jay, and today we're talking about the QYLD infinite money glitch. Yeah, that's right. QYLD already has an amazing dividend yield of over 11%. But what if you want more? What if I told you there are people taking advantage of this QYLD infinite money glitch and boosting their returns on QYLD even higher? A, how the heck are they doing it? And B, should we all jump in on the trend? First off, let me explain exactly what's going on here. The infinite money glitch for QYLD, as we've been calling it, is simply using margin to buy shares of QYLD and pocketing the difference between QYLD's dividend and the interest rate on that margin. Before we get too deep into this, I guess I have to answer, what is margin? If you're not familiar with margin, it's basically a credit line from your broker. They'll lend you money that you can go invest with, and as long as you keep that margin balance to a predetermined percentage of your overall portfolio, you can pay nothing but the interest payments on that margin for as long as you like. So what's going on with margin in QYLD is people are realizing that certain brokers have extremely favorable interest rates on the margin that they're lending out to investors. Robinhood will give you margin at 2.5%, M1 Finance will give you margin at 2%, and Interactive Brokers will give margin at 1.5%. Now you might be starting to see how this all works. QYLD's dividend yield is 10 or 11%, and if I'm borrowing margin from my broker at 2%, that's 8% in the middle that I can, in theory, pocket. So now let's look at an example and see how this might work in practice. I've got a plan. I'm gonna borrow $10,000 on margin from my broker and invest it all into QYLD. Now, as most of us know, QYLD yields around 11% and it pays dividends out monthly. So my plan is I'm gonna take that $10,000 in margin from my broker, invest it into QYLD, and with the dividends I'll be receiving from QYLD, and first, make the monthly margin interest payments that I'll be owing to my broker, and second, taking any leftover there and either reinvesting it into more QYLD or another investment of my choice. As I sit here and record this, QYLD is trading for $23.05 per share. So with that $10,000 in margin I'm theoretically borrowing, I can get about 434 shares of QYLD. And at QYLD's current dividend yield, those 434 shares will pay me $81.67 every month. But that $81.67 per month isn't all mine. Like I mentioned, we're gonna owe a monthly interest payment back to our broker on the $10,000 we borrowed. So if we borrowed this $10,000 from M1 Finance at their 2% margin rate, we're gonna owe $16.67 per month back to the broker. If we do this at Robinhood at their 2.5% rate, we'll be owing a monthly payment of $20.83. Even at the higher 2.5% interest rate that Robinhood charges, we're gonna have $60.84 per month left over after our QYLD dividend payments and what we owe the broker on that margin. Sounds simple, right? What's the catch? Oh, I'm glad you asked, because there's more than one catch. And the first catch, and the one you'll hear the most about, is the dreaded margin call. And when I say margin call, I am not referring to the excellent Kevin Spacey movie about the 2007 financial crisis. I'm talking about what happens when you're investing on margin and your investments go down. You see, with any investment that you make on margin with your broker, you're subject to what they call a maintenance level for your margin in that portfolio. If you're taking margin from your broker and investing it into QYLD, and we hit a situation like we saw in March of 2020, where the whole market went down, QYLD included, your account is gonna pass right through that maintenance level and you're gonna receive a margin call from your broker. Basically what a margin call is your broker saying, pay up, we want our money back. So when you get a margin call, what you need to do is either A, deposit more money into your investment account to get above that maintenance level threshold, or B, sell off your investments so you get that cash to pay back your broker for the money they're looking for. And if you don't do one of those two quite fast enough, your broker's not gonna send a henchman to your house to break your kneecaps, but they will force sell investments for you and just take their money. So all that sounds bad enough as it is, But you have to remember, when you get a margin call, it's because the value of your investments went down. So that means not only are you being forced to sell at maybe the bottom of the market and not being able to let your investments rebound, but you're being forced to sell at the bottom and pay back money that you borrowed from someone else. And I hope I'm making this sound as bad and dangerous as it really is, because so many people have gotten into so much trouble investing on margin and getting in trouble with a margin call. But lucky for us, a margin call isn't the only downside to investing on margin. The second risk of using margin to invest in QYLD or anything else is that margin rates aren't fixed. It's really important to remember, when you're borrowing margin from your broker, it's not like taking out a car loan or taking out a mortgage where you're getting a fixed interest rate over a set term of a loan. The reality of it is, there's no set term that you have to pay back all the principal of your margin. As long as you keep your account above the maintenance level, you can just keep making interest payments and never pay back your margin if you don't want to. But because you're not getting a fixed rate on margin like you do on something like a mortgage, your broker can change their margin interest rate at any time they darn well please. And if it so happens that they jack up that interest rate on their margin, your whole QYLD arbitrage plan that we've got in play here goes up in smoke. And jacking up the margin interest rate isn't the only way that your broker can screw you with the margin terms. You remember a little bit earlier when I was talking about a maintenance level for every investment that you make on margin? Yeah. Your brokerage can change that at any time they want as well. Your broker can increase the margin maintenance level on any stock or fund that you buy on margin to whatever it wants. At M1 Finance, the maintenance level on QYLD is currently 25%. But if tomorrow M1 Finance or Robinhood determines that QYLD is an extra risky investment all of a sudden, they can change that 25% to 50 or 75 or even 100%. Or they can remove it from being able to trade on margin whatsoever. And they don't have to give you any advance notice that they're going to do this at all. And if you think I'm just trying to scare you and this doesn't happen ever, it's just a low probability scenario, we saw this exact situation earlier this year at the height of the GameStop frenzy. When stocks like GME and AMC were going bananas and all the Wall Street bets traders were throwing every penny they had into those stocks, not only did you see a brokerage like Robinhood halt trading altogether on those stocks, but you saw brokerages across the board increase their maintenance levels on stocks like GameStop and AMC to 75% or 100%, making it almost impossible to trade on margin. So all of these things can and do happen, and when they do, it's probably at the worst possible time for you, the investor that's trading or investing on margin. The moral of this story here, I guess, is that margin is a very risky tool. Yes, you can use margin and you can amplify your gains on QYLD or just about any other investment out there. But you have to remember all the time that in using margin, not only can you amplify your gains, you can magnify your losses. And that's something you always need to be aware of. So yeah, in the best of times, you can take out a margin loan, plow it into QYLD, and work that infinite money glitch and arbitrage the difference between the QYLD dividend and the margin interest rate. And in the best of times, that could work out wonderfully for you. But as we're all aware of, the markets aren't predictable. And if you're not extremely careful with how you use margin, it can all turn on a dime and you can end up losing far more than you ever anticipated. So that's why I don't use margin, especially on an investment like QYLD, which is supposed to be a very stable income producing investment, not subjecting yourself to a lot of risk with it. And to all those people out there that are using margin to invest into QYLD and amplify that dividend yield for themselves, I really hope it works out for you. In the meantime, check out these videos over here. I hope you enjoyed this one, and I'll see you in the next one.